Welcome to Griffonomics. Today we're looking at a situation that, well, it honestly completely breaks the standard rules of market logic.
Oh, absolutely. It makes zero sense on paper.
Right. Okay, let's set the stage for you. It is Thursday, April 23, 2026. And just yesterday, a company called Medpace, ticker symbol MEDP, they released their first quarter 2026 earnings.
And just looking at the headline numbers, I mean, they absolutely crushed it.
Crushed is almost an understatement. We are talking about top-line revenue up, 26.5% year over year, up to $706.6 million,
Yeah, and the GAAP earnings per share was $4.28.
which beat Wall Street estimates by a massive 40 cents. So, by absolutely all traditional fundamental metrics, this was a huge win. A total blowout quarter.
Right, which means you'd naturally expect the stock to just surge.
Exactly. But instead, the stock violently plummeted 19% in after-hours trading. I mean, nearly a fifth of the company's value just wiped out in minutes.
It's a phenomenal paradox, really. You have this company literally printing cash, operating with zero debt, beating expectations across the board.
And the market's reaction is essentially to just hit the panic button.
Yeah, to run for the exits. But, I mean, it's a textbook example of how the stock market actually functions as a forward-looking mechanism.
Right. They don't care about the past.
Exactly. The market doesn't care about the cash you printed yesterday. It cares entirely about the structural cracks forming in the foundation of, what you're going to do tomorrow.
Which perfectly sets the mission for our deep dive today. We are going to generate a really granular strategic report and an investment roadmap for you, exploring Medpace's resilience as a highly specialized contract research organization, or CRO.
Because we really need to look under the hood of that pristine balance sheet to understand the real story here.
Right, and that means dissecting this 0.88x book-to-bill crisis that has Wall Street completely spooked right now.
Which is a huge red flag.
Totally. Plus, we're going to unpack a looming securities fraud lawsuit filed just a couple of weeks ago and examine some really sudden executive turnover at the absolute highest levels of the company.
Yeah, to really grasp the gravity of a 19% single-day drop, we first have to understand the specific mechanical role Medpace plays in the global economy.
Because it's a very unique niche, right?
Extremely unique. They operate a business model that is entirely insulated from the risk of scientific failure, but at the same time, deeply exposed to the whims of the capital markets.
Right, because developing a new drug is, it's an arduous, almost impossibly difficult process.
Oh, it takes on average 10 to 15 years from the initial discovery of a molecule in a petri dish to actually getting an FDA approval.
Wow, 10 to 15 years. And the financial barrier to entry is just staggering. I was looking at a comprehensive 2020 study for this deep dive, and it pinned the median cost of bringing a single new drug to market at roughly $985 million.
Yeah, almost $1 billion. Just to find out if a compound actually works safely in human beings.
It's wild. And I think most people assume that kind of capital and time commitment means all the innovation is coming from the massive household name pharmaceutical giants, like the Pfizers and the Mercks of the world.
Right. That's the common assumption. But the reality of the modern biotech space is that the most cutting-edge innovation is actually coming from small and mid-sized biopharma companies.
Basically virtual companies, right?
Exactly. They might literally just consist of a dozen brilliant scientists, a really promising molecule, a rented office somewhere, and like a pile of venture capital funding.
Right. So they absolutely do not have the global infrastructure or the regulatory expertise.
Or the manpower. I mean, they can't run a global, multi-year clinical trial involving thousands of patients spread across dozens of countries.
Yeah, they don't have a pharmacovigilance department to monitor adverse patient reactions in real time.
Or specialized bioanalytical laboratories in Belgium or China to process blood samples. They just have the foundational science.
So they have to outsource all that heavy lifting of the clinical trials.
Right, and that is the exact gap a contract research organization, a CRO, fills.
Oh.
Medpace is basically hired to run the entire mechanical process.
From start to finish.
Exactly. From designing the complex trial protocols, to navigating the ethical review boards, recruiting the patients,
Managing all the data,
running the lab tests, and ultimately filing those massive, thousands of pages long stacks of paperwork with regulatory agencies.
like the FDA here in the US or the EMA over in Europe.
Right. So, keeping that in mind, we really need to evaluate whether this stock is, a volatile value trap or a high-quality asset currently trading at a massive misunderstood discount.
Let's look at how Medpace actually operates day to day, because their core competitive moat is fascinating. I mean, most companies build a moat. Medpace essentially built a walled city.
That's a great way to put it. It's their end-to-end, vertically integrated model. It is the defining operational characteristic of the entire company.
Because in the CRO industry, there are different ways of doing things, right?
Yeah, there are different methodologies.
Yeah.
The giant legacy CROs companies like IQVIA or ICON, they often operate on what is known as functional outsourcing
Yeah.
or flexible staffing.
Which is kind of like a massive temp agency for scientists.
Exactly like that. If a large pharmaceutical company has its own trial running, but suddenly realizes, hey, we need an extra team of 50 data analysts for 6 months.
Or they need a specific lab test run on 1,000 samples.
Right. Those large CROs will happily provide those a la carte services. They just slot their people into the client's existing machinery.
But Medpace categorically refuses to do that.
Absolutely refuses. They bring everything in-house.
It's a total all-or-nothing approach.
Mm.
If a biotech firm hires Medpace, Medpace demands control over the clinical trial management, the regulatory affairs, the medical writing, the safety monitoring, everything.
They even mandate the use of their own specialized imaging and cardiovascular core laboratories.
Wait, they even have their own clinics, don't they?
Yeah, they actually operate their own clinical pharmacology clinics right in Cincinnati, specifically for housing and testing healthy volunteers in early phase I trials. They control the entire ecosystem from top to bottom.
Which is brilliant, because by mandating that level of control and bringing everything under one roof, Medpace eliminates the frictional handoffs between different vendors.
Exactly. In a normal, fragmented trial, there is constant waiting. You are waiting for a third-party lab in another time zone to process a sample, format the data, send it back to a third-party medical writer.
Who then has to translate it and send it to the sponsor for review? It just creates massive operational lag.
Right. But because of Medpace's tight integration, they can execute clinical trials approximately 30% faster than large pharmaceutical companies can internally.
That 30% number is huge. I want to make sure the mechanics of that speed advantage are crystal clear for you listening. You could buy all the parts for a car from different specialized suppliers and try to have a neighborhood mechanic put it together, right?
Dealing with shipping delays, mismatched parts, communication breakdowns.
Exactly. Or you could hand the entire operation over to a Formula One pit crew. In a pit crew, every single person is perfectly synchronized,
Using the exact same real-time telemetry data.
operating under one roof with a unified chain of command. And in the biotech world, time is quite literally measured in billions of dollars.
That's the key. The moment a company files a patent for a new drug, a 20-year countdown clock starts ticking.
And out of those 20 years, the clinical testing phase historically eats up about, 7.5 years?
On average, yeah. So every single month Medpace can shave off that trial timeline translates to an extra month of exclusive patent-protected sales for the client once the drug finally hits the market.
We are talking about adding tens or even hundreds of millions of dollars to a drug's lifetime commercial value simply by executing the trial faster.
It creates a phenomenally compelling value proposition for their clients.
Uh-huh.
And importantly, it is an asset-light model for Medpace itself.
Right, because they don't invent the drugs.
No, they do not own the intellectual property of the molecules they test. They do not have to build multi-billion-dollar manufacturing plants to mass-produce the pills once approved.
They're purely the executors of the research process.
Which means whether a drug goes on to be the next blockbuster cure generating billions in revenue, or an absolute failure that shows terrible liver toxicity in phase 2 and gets abandoned.
Medpace gets paid either way for executing the trial.
Exactly. They are completely insulated from the direct scientific risk of drug discovery.
And this is a big skeeds, but they're deeply exposed to a different kind of risk. Because looking at their client concentration in the sources, it honestly feels like a massive structural vulnerability.
Oh, the concentration is extreme.
According to their SEC filings, 96% of Medpace's revenue comes from small and mid-sized biopharma companies. 96%.
And it gets even more extreme than that. 82% of their total net revenue for 2025 came specifically from small biopharmaceutical companies.
And how does the industry define small here?
Usually companies having less than $250 million in annual sales, often pre-revenue entirely.
See, if you are operating a multi-billion-dollar service company, ignoring the biggest, wealthiest potential clients in the world, the massive pharmaceutical conglomerates with bottomless pockets, that seems almost reckless to me.
It definitely looks that way on the surface.
Like, why build a business model that actively turns away the deepest pockets in the room?
Well, it speaks to a very deliberate, unyielding strategic divergence by Medpace's founder and CEO, August Troendl. Large pharma companies already have massive, complex internal systems and deeply entrenched bureaucracies.
So they wouldn't want the full Medpace ecosystem anyway.
Right. As we discussed with the functional outsourcing model, Big Pharma wants a CRO to provide flexible, a la carte staffing. They want to dictate the terms.
They want to say, here is our proprietary protocol, here is our legacy software system, just give us 50 clinical research associates to monitor the hospital sites and follow our rules.
Exactly. And Medpace fundamentally refuses to break apart its highly efficient full-service engine just to act as temporary labor for someone else's system.
Which makes sense.
Troendl's philosophy is that attempting to accommodate the fragmented bureaucratic models of Big Pharma would essentially destroy Medpace's core efficiency and speed advantage. They would become just another low-margin staffing agency.
So they deliberately stick to their sweet spot, the virtual and small biotech firms that have incredible science but zero infrastructure.
The firms that desperately need someone to take the wheel, manage the entire chaotic process, and drive it across the FDA finish line.
But while that is a great strategy, it creates a profound macroeconomic vulnerability, doesn't it?
Oh, absolutely.
Hmm.
It makes Medpace entirely dependent on the highly cyclical biotech funding environment.
Because small biotech firms generally do not have recurring revenue from existing drug sales to fund their research.
They survive entirely on external capital, venture capital injections, secondary stock offerings, licensing deals.
So if interest rates are high, or the macroeconomic environment is tough, and small biotech cannot raise that external capital.
Their research and development budgets evaporate overnight, and when those R&D budgets dry up, Medpace's order book dries up alongside them.
Wow. So they are insulated from the failure of a single drug, but they are highly, almost dangerously exposed to the financial health of the entire small biotech sector.
That is the exact trade-off they've made.
Which brings us directly to the immediate crisis driving that 19% stock plunge. The financial health of that small biotech sector is exactly what seems to be cracking right now.
Yes. We need to talk about the book-to-bill crisis.
In Q1 2026, Medpace's net book-to-bill ratio plunged to 0.88x.
And this specific metric is the exact trigger for the after-hours panic. The book-to-bill ratio is the primary forward-looking indicator of health in the CRO industry.
Let's break that math down. It is calculated by taking the net new business awarded to the company during the quarter of the book and dividing it by the revenue recognized in that same quarter of the bill.
Right, so if Medpace signs $100 million in brand new contracts this quarter, and they also bill $100 million in revenue for trial work they actually completed this quarter, their ratio is 1.0.
Okay, so they are replacing their backlog of future work exactly as fast as they are burning through it?
That is the exact mathematical baseline. So a ratio under 1.0 means you are burning through your backlog faster than you are replenishing it. You are literally eating into your future runway.
And historically, Medpace sits very comfortably in expansion territory, right?
Very comfortably, usually between 1.10x and 1.25x. But the recent trend line is what terrified institutional investors.
What does the trend look like?
Well, in Q3 2025, it was a healthy 1.20x. Then in Q4 2025, it dropped to a concerning 1.04x.
Which actually triggered a 16% stock drop back in February of this year, if I recall.
It did. And now, in Q1 2026, it has plummeted all the way to 0.88x. That is a blaring siren indicating that growth is stalling out.
And the primary driver dragging that ratio down is a massive surge in cancellations. Backlog cancellations have reached their highest point in over a year.
Yeah, and the CEO, August Troendl, was pressed really hard on this during the Q1 earnings call.
His explanation was shockingly blunt. I have the quote right here. He blamed the cancellations on, quote, random stuff.
Which, I mean, it sounds so dismissive on a highly scrutinized earnings call, but random stuff actually has a very specific mechanical meaning in the context of clinical drug trials.
Right. He didn't mean they just lost the paperwork.
No. Troendl explicitly clarified that these elevated cancellations are not being driven by acute macroeconomic funding shortages or venture capital suddenly drying up in the first quarter.
So it's not a macro problem.
Rather, it's the natural inherent friction and failure rate of drug development. He's referring to product performance failures.
Like the drug just doesn't work.
Exactly. For instance, a drug might show unexpected toxicity in liver during a phase 2 trial, making it too dangerous to continue. So the sponsor immediately kills the project, and cancels the rest of the contract.
Or maybe a simple lack of clinical efficacy. The drug is safe, but it just doesn't actually cure the disease.
Right. He also pointed to trial reprioritizations, where a small biotech firm with limited cash looks at its portfolio and decides to halt drug B to focus all its remaining capital on a more promising drug A.
But looking at the sources, there is a fascinating paradox hidden in the way these cancellations are accounted for. This blew my mind. Sometimes a cancellation hitting that metric actually happens because Medpace performs too well.
Yes. The accounting mechanics surrounding this metric are deeply counterintuitive, and they often penalize operational excellence.
Let's walk through an example to make this clear for you because it's wild. Imagine a small biotech client hires Medpace for a major trial. They sign a contract with a budget designed to cover 2 full years of patient recruitment, right?
Because finding, say, 500 eligible patients for a rare disease usually takes at least that long.
Exactly. But Medpace deploys its highly efficient, vertically integrated system. Their in-house recruitment teams and global site networks operate flawlessly, and they manage to recruit all 500 patients in just 12 months.
Half the time.
Half the time. Because they finished a year early, the unused budget for that second year of recruitment is returned to the client.
Which the client obviously loves.
Of course. But under standard accounting rules, that reduction in the overall contract value is officially recorded as a cancellation.
Yep. They are literally taking a PR hit and damaging their key forward-looking metric as a direct result of extreme efficiency.
It's insane.
CEO Troendel has expressed deep, recurring frustration with this dynamic. He routinely calls the book-to-bill ratio a flawed measure of performance under the current ASC 606 accounting rules because of this exact scenario.
Because if they recognize revenue faster than expected because they are hitting milestones early, the denominator of the ratio goes up.
Simultaneously, because the trial is finishing under budget, the total contract value is reduced, which acts as a drag on the numerator.
So the ratio plummets and looks like a massive miss to Wall Street algorithms, even when operational execution is absolutely stellar and the client is thrilled.
That's a tough spot to be in optically.
But even factoring in the accounting quirks, we have to do some objective backlog forensics here. If we zoom out and look at the macro trends beyond a single quarter's efficiency, the pipeline is undeniably decaying.
It is. Now, the short-term backlog conversion actually looks incredibly strong. They have a 23.3% conversion rate, with $1.94 billion in contracted work expected to convert to actual revenue in the next 12 months.
So they have plenty of work for the immediate future. The lights are staying on.
The immediate future is very secure. But the long-term pipeline is what dictates market valuation, and that pipeline is shrinking.
Right. Analysts on the earnings call honed in on a very grim reality. Backlog coverage beyond year 1, meaning the contracted work expected to be performed in years 2 and 3, has declined for 6 consecutive quarters.
6 quarters. That means we are not looking at a one-quarter blip caused by a few drugs failing. We are looking at a sustained, multi-year trend of the long-term runway eroding.
And adding to the anxiety of a shrinking long-term backlog is the fact that actual new business coming in the front door is slowing down.
Yes. Requests for proposals, or RFPs.
Which are essentially the formal invitations from biotech companies asking Medpace to bid on running a new trial, right?
Exactly. Those RFPs were down both sequentially from the fourth quarter and year over year.
And the CEO was remarkably candid about this reality. He admitted point blank on the call that sequential revenue growth going forward is a real question.
I mean, that kind of unvarnished honesty from a CEO is refreshing from a transparency standpoint, but it is absolute nightmare fuel for an institutional investor who bought the stock expecting continuous compounding growth.
Which perfectly frames the paradox of that 19% drop. The long-term pipeline is collapsing, but the current present-day financials are an absolute fortress.
The divergence between their future outlook and their present reality is staggering.
Let's unpack the present reality and that massive earnings beat, because while the future looks murky, the present is incredibly lucrative.
Unbelievably lucrative.
Q1 2026 revenue came in at $706.6 million, representing a 26.5% year-over-year increase. And if you strip out foreign exchange fluctuations and look at constant currency, it's still a massive 25.8% increase.
And JAP EPS was $4.28, beating Wall Street expectations by 40 cents. Net income was $123.9 million, an 8.1% increase year over year.
Now, that net income growth actually looks a bit muted compared to the revenue growth.
It does, but that was driven by a much higher effective tax rate this quarter. They faced a 16.1% tax rate compared to just 3.0% in Q1 2025, primarily due to a significant decrease in excess tax benefits related to share-based compensation.
Okay, that makes sense. To understand why the revenue and earnings are so strong despite the backlog issues, we have to look at the mechanics of those ASC 606 accounting rules you mentioned.
Right. Revenue recognition on fixed fee and unit of service contracts means Medpace is executing brilliantly on the work they already have in their immediate short-term backlog.
Explain the fixed fee part. Most of their contracts are structured that way, right?
Yes. Under a fixed fee arrangement, Medpace agrees to run a trial for a set price, let's say $50 million. They bear the entire financial risk if they underestimate the labor costs or run into operational delays.
But they recognize that $50 million in revenue proportionally as they hit specific performance milestones?
Exactly.
So if they figure out a way to hit those milestones using fewer labor hours, their margins explode.
Precisely. And the fact that their EBITDA margins remained rock solid at 21.1% in Q1 demonstrates that their clinical trial managers are keeping an incredibly tight grip on internal costs.
They are highly efficient operators.
Furthermore, despite the 0.88x book-to-bill crisis and the elevated cancellations, management actually reaffirmed their full-year 2026 financial guidance.
Wait, they didn't lower guidance at all?
Not at all. They are still projecting $2.755 billion to $2.855 billion in full-year revenue and $605 million to $635 million in EBITDA.
Wow. CFO Kevin Brady explicitly stated on the earnings call that despite the severe cancellation headwinds they faced in Q1, the internal models still make them feel very good about hitting that massive guidance range.
It's a huge show of confidence. And that operational efficiency also translates into staggering cash conversion metrics.
Let's talk about the cash, because this is wild. In Q1 2026 alone, Medpace generated $145 million in free cash flow.
That reflects a 97.1% free cash flow conversion rate relative to their EBITDA for the quarter.
97.1%. This is where the asset-light model we discussed earlier truly shines, isn't it?
Oh, absolutely. Because they don't have to constantly sink capital into building manufacturing plants or buying massive amounts of raw materials or managing vast physical inventories. Almost all of their operating profit turns straight into cold, hard, usable cash.
Which leads to a balance sheet that is virtually bulletproof. As of March 31st, 2026, Medpace has absolutely zero outstanding debt. Nothing.
Zero debt in this interest rate environment is a massive advantage.
And they are sitting on a massive $652.7 million cash position. So putting on the hat of a highly skeptical shareholder here, I have to ask, if management is so openly worried about the long-term pipeline decaying and RFPs are trending down, why in the world are they throwing hundreds of millions of dollars at share buybacks?
Instead of hoarding that cash for a rainy day.
Yeah, or aggressively acquiring other companies to diversify their revenue streams.
It's a fair question. But it comes back to the core capital allocation philosophy of August Troendel. They view their own stock, their own operational engine, as the single best possible investment they can make.
So no dividends.
They do not pay a dividend to shareholders. Instead, they actively and aggressively reduce their outstanding share count through massive buyback programs.
Just how massive are we talking?
In the full year of 2025, they repurchased approximately 2.96 million shares for a whopping $912.9 million.
Almost $1 billion in buybacks in 1 year.
Yes, and this aggressively reduced their weighted average diluted shares outstanding from 32 million in 2024 down to about 28.9 million in Q1 2026.
So they are artificially boosting the earnings per share by shrinking the denominator, concentrating the underlying value for existing shareholders rather than diluting it.
It is a classic concentration strategy. Now, it is worth noting that they actually paused these buybacks in Q1 2026.
Wait, really? They didn't buy any shares this past quarter?
They executed 0 share repurchases during this specific quarter, likely preserving capital while navigating those elevated cancellations.
Right.
But they still have $821.7 million in formal authorization left from the board to deploy whenever they choose.
And the lack of desperate, panicked acquisitions shows immense operational discipline, honestly.
Right. When growth slows, many companies will just buy a random data analytics firm or a smaller rival just to artificially inflate their top-line revenue numbers and appease Wall Street.
But Medpace is refusing to do that. They are sticking to their high-conviction, founder-led culture, trusting that their core model will weather the cycle.
Exactly.
Well, since we are talking about their core operational model, let's explore how they actually manage this kind of scale, because we are talking about 6,300 employees scattered across 46 different countries, managing highly sensitive biological data.
It's a logistical nightmare on paper.
How does Medpace keep the entire Formula One pit crew synchronized globally?
The central nervous system of their entire physical operation is their proprietary software ecosystem called ClinTrack.
ClinTrack.
Okay, and this is not just a generic administrative portal or a glorified spreadsheet. ClinTrack hard codes their standard operating procedures directly into the daily workflow of every single employee.
So it forces compliance.
Exactly. It provides clinical trial managers in Cincinnati with real-time study metrics from a hospital site in Tokyo or a clinic in Berlin. It allows them to monitor patient recruitment pacing, evaluate site performance, and detect potential safety signals globally the moment they are entered into the system.
And they use it for their lab work too, right?
Yes. It is the dedicated infrastructure that allows their internal core laboratories to securely partner with imaging experts at major academic institutions. They use it for the prompt, standardized reading of electrocardiograms and complex medical scans, ensuring that every piece of data meets FDA standards, regardless of where in the world the patient is located.
You know, whenever we discuss proprietary software and operational efficiency in 2026, we have to address the elephant in the room that has been driving so much volatility in the tech and biotech sectors. Artificial intelligence.
Ah, yes, AI.
The broader market has been absolutely terrified that generative AI and advanced machine learning models will render traditional human-heavy CROs completely obsolete.
Right, the prevailing fear is that an AI will soon be able to automate clinical data collection, draft massive medical writing reports, and format complex regulatory submissions so perfectly and cheaply that a small biotech firm won't need to pay Medpace hundreds of millions of dollars to do it.
Which is a valid theoretical concern that has caused massive sector rotation. But Medpace's management has taken a refreshingly blunt, highly realistic stance on the actual capabilities of AI in a heavily regulated environment.
Very realistic. They're not burying their heads in the sand. They are actively exploring machine learning and generative AI for internal use.
But they aren't seeing massive gains yet.
They are seeing some minor efficiencies in basic repetitive internal processes. But Trowendell explicitly stated on the earnings call that Medpace will not see any net productivity benefit from AI for at least 2 full years.
At least 2 years. I think the best way to visualize what management is saying here is to imagine renovating a highly successful, incredibly busy restaurant, but you are forced to keep it open for dinner service every single night during the construction.
That's a great analogy.
Right, because yes, tearing out the walls and putting in a state-of-the-art automated kitchen will eventually make the chefs faster and the food better.
Eventually.
But the immediate, massive cost of the renovation, the absolute disruption to the staff trying to work around the construction, the hundreds of hours of training required to learn the new equipment.
And the heavy upfront capital investment.
Exactly. All of that will completely obliterate any near-term efficiency gains. You are going to lose money and time in the short run to build the system of the future.
The integration costs and the operational friction of implementation are massive. Furthermore, Medpace's board of directors is actively monitoring the operational risks of AI, which are categorically not trivial in this industry.
Oh, I can imagine. When you are dealing with FDA submissions and human clinical trial data that dictate whether a drug is safe for public consumption, you cannot afford hallucinations from a generative AI model.
Exactly. If an AI hallucinates a p-value in a clinical efficacy report, or misses a subtle safety signal in a patient's lab results, the FDA will issue a complete response letter, effectively killing the drug.
And potentially costing the client $1 billion.
Right. Because of that extreme risk profile, the use of AI currently requires extensive human oversight. You have to hire experts just to monitor the AI, write new standard operating procedures to govern its use, and build robust safeguards against system disruptions in these resource-intensive platforms.
So the human oversight essentially negates the immediate labor savings.
For now, yes.
It seems the smart money actually agrees with management's measured, realistic approach, though. Analysts at Barclays recently upgraded Medpace's stock to overweight.
Yeah, they specifically noted in their research that the market's fears of an immediate AI disruption in the CRO space are drastically overblown.
The reality of executing physical clinical trials across dozens of international regulatory regimes is far too complex and highly regulated to be handed over to an algorithm anytime in the near future.
While AI might represent a theoretical threat years down the line, Medpace is currently facing Very real, very immediate threats on the legal and governance front.
Yeah, the market might be overreacting to AI, but they are rightfully concerned about the fallout from recent corporate events. Let's lower the tone a bit to talk about the severe storm cloud currently hanging over the company's executive suite.
The lawsuit.
On April 6, 2026, a massive class action securities fraud complaint was officially filed in the U.S. District Court for the Southern District of Ohio.
And it names Medpace as a company, along with CEO August Troendel, retiring President Jesse Geiger, and CFO Kevin Brady as individual defendants.
So, what exactly is this lawsuit alleging?
Well, this lawsuit is a direct, aggressive consequence of the massive stock volatility we discussed earlier. Specialized shareholder rights law firms, like Levi and Korsinski and the Show Law Firm, are currently investigating and gathering plaintiffs.
Okay.
The core mechanics of the allegations are that Medpace's management deliberately made materially false and misleading statements about the underlying health of the booking pipeline and their internal cancellation rates.
So they're claiming management actively deceived the broader market.
Essentially, yes. Shareholders who lost significant money during the massive 15.9% stock drop back in February 2025, and now this subsequent 19% drop in April, are claiming that management possessed internal data showing elevated cancellation rates and a rapidly deteriorating book-to-bill ratio long before they adequately disclosed the severity of the problem to the investing public.
Now, if you're looking at this from the outside, you have to keep in mind that Medpace has not recognized any formal financial liability for this lawsuit yet.
Right, legally they haven't conceded anything.
In their official 10Q filing with the SEC, they explicitly stated that a financial loss isn't currently probable or reasonably estimable, which is the legal threshold required to actually take a charge against their earnings.
But honestly, regardless of the ultimate courtroom outcome, or whether it ends in a massive settlement, it adds a very heavy, very expensive legal overhang to a stock that is already struggling with a decaying pipeline. And that intense legal pressure is compounded by a major leadership pivot announced on the exact same Q1 earnings call.
Yeah, this was a shock. President Jesse Geiger is retiring on May 31st, 2026.
He has been with the company for 18.5 years. I mean, that is a massive tenure, serving as a foundational pillar of their executive team.
Now, the corporate press release was incredibly quick to note that his departure is not due to any disagreements with the company, its operations, policies, or practices.
Of course they'd say that, but the optics are terrible. Losing your president, a guy who has been intricately involved in operations for nearly 2 decades during a historic booking crisis and the launch of a class action securities fraud lawsuit. It is deeply unsettling for institutional investors looking for a steady hand at the wheel.
And the transition plan adds another layer of complexity. In the interim, CEO August Troendel is stepping in to absorb and cover the president's duties until a formal successor is identified.
Which brings us to a critical structural dynamic within Medpace. Troendel is the ultimate owner-operator.
Right. He didn't just get hired to run the company.
No, he founded Medpace back in 1992. He currently controls approximately 19% of the outstanding common stock, largely through his control of an investment entity called Medpace Investors, LLC.
And he also takes a highly modest base salary for a multi-billion-dollar public company CEO, right?
Yeah.
He takes home just $700,000.
So his personal wealth is tied almost entirely to the long-term survival and stock performance of the company.
Which normally, having skin in the game is exactly what investors want. It aligns his incentives perfectly with the shareholders.
Usually, yes.
But looking at the broader structure, does this start to look a little too much like a corporate fiefdom? I mean, when the original founder owns 19% of the equity, is acting as the CEO, serves as the chairman of the board, and is now stepping in as the interim president, where are the operational checks and balances?
It is a vital governance question. And if we dive into the proxy statement, the DAF 14A filing, there is a complex web of related party transactions that absolutely validate concerns about power concentration.
What kind of transactions?
For example, the filings show that Medpace generated over $53 million in 2025 revenue from 2 very specific small biotech clients.
Okay.
A company called Leb Therapeutics, which accounted for $7.9 million,
Yeah.
and another called SnareX Pharma, which accounted for a massive $45.3 million in revenue.
Wait, so what is the executive connection to those specific clients?
CEO August Troendel and Medpace's general counsel Stephen Ewald both sit on the board of managers and hold direct equity stakes in both of those biotech companies.
Let me synthesize that, because it's a stunning dynamic. The CEO is effectively sitting on both sides of the negotiating table.
Yes, he is.
He is a part owner of the biotech company requesting the trial services, and he is the CEO of the CRO executing those services and booking the revenue.
Right.
Even if everything is priced fairly, how is that not perceived as a massive structural conflict of interest?
It is highly scrutinized, to say the least. And the governance web goes even further into physical real estate.
Oh boy.
Medpace routinely incurs substantial expenses at a property called the Summit Hotel, which is conveniently located right on their corporate campus in Cincinnati. The Summit Hotel is owned by Troendel.
Of course it is.
Furthermore, Medpace leases its massive campus headquarters real estate from an entity that is wholly owned by Troendel. That specific real estate lease was just renewed for another 10 years, extending through 2032.
Unbelievable.
And as a final note on internal dynamics, the proxy openly discloses that the CEO and the Executive Vice President of Operations, Susan Bertwig, cohabitate.
Wow. So the internal power structure is highly, highly concentrated among a very small, deeply interconnected group of people.
It is the definition of an entrenched owner-operator model. Now, to provide the full picture, the company discloses all of these relationships transparently in their SEC filings, so investors are fully aware before buying the stock.
Right. It's not a secret.
And on a positive governance note, the board of directors is currently undergoing a shareholder-friendly declassification process.
Oh, that's good. Meaning that instead of staggered multi-year terms that make it impossible to vote out a board, all directors will face annual elections by 2027.
Yes. Management is also formally proposing to eliminate supermajority voting requirements, which should theoretically improve stockholder rights.
But despite those structural improvements, the profound concentration of executive power remains a significant factor for any institutional investor evaluating the long-term governance risks of this stock. Let's zoom out from the internal executive web for a minute and look at the macro environment. We've talked about the internal issues. Let's talk about the external macroeconomic forces actively squeezing Medpace right now.
Okay.
Specifically, I want to explore the client M&A headwinds. We established earlier that Medpace strategically, purposefully avoids big pharma to maintain its speed advantage. But what happens mechanically when a massive pharmaceutical giant swoops in and buys one of Medpace's highly successful small biotech clients?
This exposes a massive structural vulnerability in Medpace's pipeline. It's a phenomenon known in the industry as being cut out on future work.
How does that work? Let's walk through the mechanics.
Okay, imagine a small virtual biotech client of Medpace has a highly successful phase 2 trial for a groundbreaking new oncology drug. Medpace ran the trial flawlessly, the data is pristine, and the drug looks like a guaranteed blockbuster.
Okay, so the small client is thrilled.
A massive big pharma conglomerate sees that data, swoops in, and acquires that small biotech firm for, say, $5 billion. The very moment that acquisition closes, the big pharma company takes absolute control of the drug's future development pipeline.
And because Big Pharma fundamentally hates Medpace's inflexible, all-or-nothing, full-service model,
they vastly prefer to use their own legacy systems and their own preferred functional outsourcing vendors like IQVIA.
so Medpace gets fired.
Almost immediately. Medpace is cut out of running the massive, incredibly lucrative phase 3 trials for that exact drug they helped prove was effective.
So it's a brutal paradox. Medpace's own operational success in running a flawless phase 2 trial makes their client an incredibly attractive acquisition target. And when the client gets acquired because of that success, Medpace is punished by losing the future business.
It's a structural ceiling on their long-term upside with any given drug. CEO Troendel admitted point-blank on the call that acquisitions are not good for us.
Though, to be precise regarding the current quarter, he did clarify that the recent Q1 spike in cancellations we discussed was not driven by a sudden surge in M&A activity, but rather those inherent product safety and efficacy failures.
Right, which logically leads us to examine the specific therapeutic volatility. Where exactly within their diverse pipeline is the bleeding actually happening?
Well, Medpace breaks down its revenue by therapeutic area. In Q1, their oncology segment cancer research generated $201.2 million, making it a massive part of their business.
And their cardiovascular segment generated $56.2 million. On the call, Troendel explicitly noted that the elevated Q1 cancellations were predominantly concentrated within these two specific therapeutic areas.
Which, if you understand the underlying science, makes logical sense. Oncology is inherently massively risky.
Oh, incredibly risky. You are dealing with complex biological mechanisms.
Essentially trying to develop a targeted poison that kills a mutating tumor without killing the human host. The trials are highly prone to unexpected toxicity, severe adverse patient events, and ultimately high rates of late-stage phase trial failures.
It is the brutal nature of cancer science. High failure rates are priced into the model. But what's truly fascinating here is the contrarian fact hidden deep in their therapeutic breakdown regarding their largest single segment.
Oh, you mean metabolic disease?
Yes.
Yes, the data on this completely upends the broader market narrative. Their metabolic segment generated a staggering $237.5 million in Q1 revenue, making it their biggest revenue driver.
And this segment includes the clinical trials for GLP-1 weight loss drugs.
Which are, without a doubt, the hottest, most talked about, most heavily invested drugs on the planet right now.
Yeah.
Things like Ozempic and Wegovy have created an absolute gold rush in the pharma industry.
They really have. And because of that gold rush, the broader market assumes the metabolic space must be incredibly volatile, deeply saturated, and hyper-competitive.
Right. Retail investors and some analysts were terrified that small biotech firms were suddenly canceling their GLP-1 trials because they realized they simply couldn't compete with the massive marketing budgets of Novo Nordisk and Eli Lilly.
The market assumed the GLP-1 bubble was bursting for small players. But the internal data completely contradicts that narrative.
What did the CEO say about it?
On the earnings call, when pressed hard by a skeptical analyst about GLP-1 volatility and potential cancellations, Troendl revealed a critical piece of information. The metabolic segment historically maintains the lowest cancellation rate across all of their major therapeutic areas.
Wait, the lowest, despite all the hype and competition.
Despite the intense, seemingly chaotic market competition, the actual clinical trials for these metabolic drugs are highly stable, reliable, and consistent revenue generators for Medpace.
That stability likely comes from the fact that the underlying biological mechanisms of GLP-1s are now very well understood, right?
Exactly. Unlike oncology, where you are constantly fighting unknown cellular mutations, metabolic trials are mostly about proving efficacy, scaling dosages, and managing relatively known side effects like nausea.
So it's less about catastrophic trial-ending toxicity and more about optimization. It is a critical, highly lucrative nuance that the broader market seems to be entirely mispricing in their panic.
We have covered an immense amount of ground here, dissecting the business model, the accounting mechanics, the executive web, and the therapeutic risks.
We really have. Let's synthesize this all into a final, coherent verdict. What is the ultimate strategic and investment outlook for Medpace?
If we have to categorize this asset based on everything we've unpacked, Medpace is deeply, fundamentally paradoxical. It must be rated as a volatile but undeniably high-quality asset.
Okay, let's summarize the quality side of the ledger first. It is a fiercely independent, founder-led business operating with a flawless balance sheet, zero debt, massive, reliable, free cash flow generation.
Right. Its vertically integrated, full-service operational model genuinely runs laps around large pharmaceutical companies in terms of raw trial execution speed.
Providing a massive structural competitive advantage that protects its 21% EBITDA margins, even when the pipeline slows.
But the volatility side of the ledger is equally heavy. They are currently burning their future runway to maintain those margins.
Right. The long-term backlog covering years 2 and 3 is steadily shrinking. The vital RFPs are trending down. The critical forward-looking book-to-bill ratio is stuck at a terrifying 0.88x, and sequential revenue growth has functionally stalled.
Combine that deteriorating macro picture with the heavy overhang of a class action securities fraud investigation and the sudden unsettling retirement of their longtime president, and you have a recipe for severe, sustained, near-term turbulence in the stock price.
Which means the entire investment thesis, whether you think the 19% drop is a massive overreaction or a justified correction, hinges on one single critical factor: the stabilization of the order book.
That's the bottom line. Until Medpace's internal sales and win rate initiatives begin to meaningfully and demonstrably expand their gross new business awards, or the macroeconomic biotech funding winter finally thaws and venture capital begins flowing freely back into small biopharma research and development, the stock will remain trapped in a highly volatile holding pattern.
It highlights the ultimate unforgiving truth of the public markets. Past performance and pristine balance sheets are a matter of historical record, but valuation is entirely exclusively a matter of future expectations.
Perfectly said.
I want to leave you with one final provocative thread to pull on as you consider this analysis. Consider the potential for a massive operational slingshot effect.
Okay, I like where you're going with this.
We noted that despite the weak book-to-bill ratio and the decaying pipeline, CEO August Tremendal explicitly stated on the call that Medpace is actively continuing to hire new personnel to support future growth.
Right. They're aggressively maintaining and even expanding their global operational capacity rather than laying people off to protect short-term earnings.
So what happens mechanically the moment interest rates drop? The macroeconomic environment shifts, and venture capital suddenly floods back into the small biotech sector.
It creates a fascinating competitive scenario.
Exactly. If Medpace is keeping their massive, vertically integrated Formula One pit crew fully staffed, fully trained, and idling on the starting line, while their more reactive competitors might be actively scaling back or laying off staff to protect margins during the downturn.
The very exposure to the small biotech sector that is currently dragging Medpace down could position them for an unprecedented explosive rebound.
When the venture capital funding taps turn back on, Medpace might be the only global CRO with the immediate deployable human capacity to catch the massive flood of new trial requests. Just something to mull over as you watch the biotech sector.
Very tough.
Risk defined, portfolio protected.